Analysis of futures pricing and related concepts, an exploration of futures pricing dynamics. Agenda items, fundamentals of futures pricing, costs of carry and related concepts, benefits and calculations related to carry, interest and dividends in futures pricing, market conditions and futures pricing, impact of yields and supply issues. Understanding futures contracts. Definition of futures contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specified future date. Standardization and trading. These contracts are standardized, meaning they have specific terms that facilitate trading on exchanges. Accessibility for participants. Futures contracts are accessible to various market participants, including investors, traders, and hedgers. Fair value of futures. Definition of fair value. The fair value of futures is the expected future price of an asset, adjusted for various market conditions. Cost of carry adjustment. The cost of carry includes costs like storage and financing, influencing the futures price relative to the underlying asset. Market pricing implications. Traders use fair value calculations to assess whether futures contracts are overvalued or undervalued in the market. Cash price of the underlying assets. Definition of cash price. The cash price is the current market price of the underlying asset, reflecting its immediate value. Importance of futures. Understanding the cash price is essential for calculating the fair value of futures contracts. Market dynamics. The relationship between spot and futures prices is crucial for understanding market dynamics. Definition and components of costs of carry. Storage costs. Storage costs are expenses incurred for physically holding assets, which can vary based on the asset type and storage duration. Insurance costs. Insurance costs protect assets against risks and losses, influencing overall costs associated with carrying an asset. Financing costs. Financing costs refer to interest or fees incurred when borrowing to acquire an asset, impacting the total cost of carry. Costs in the cash market. Costs of carry. The costs of carry are expenses associated with holding an asset, impacting investment value assessments. Investor decision making. Investors must weigh the costs of carry against immediate selling prices when making decisions. Impact on trading strategies. The cost of carry can significantly influence trading strategies and how assets are managed in portfolios. Holding cost. Definition of holding costs. Holding costs represent the expenses associated with maintaining an investment over a period. They can affect the overall return on investment. Impact on futures pricing. Holding costs can significantly influence futures pricing, especially for commodities that have high storage fees. This relationship affects market dynamics. Storage fees for commodities. Commodities with high storage fees tend to have higher holding costs, which directly impact their market pricing and investment strategies. Benefit of carry. Understanding benefit of carry. The benefit of carry indicates potential gains from holding an asset, enhancing investment returns. Price appreciation factors. Price appreciation and value-adding factors significantly contribute to the overall benefit of carry for investors. Evaluating futures contracts. Investors calculate the benefit of carry when assessing futures contracts, guiding their investment decisions effectively. Fair value calculation. Importance of fair value calculation. Fair value calculation helps traders identify mispriced futures contracts, enabling informed trading decisions. Components of the formula. The fair value formula considers current cash prices, costs of carry, and time until contract expiration. Market analysis. Accurate fair value calculations lead to better market analysis and trading strategies for futures contracts. Cash index. Definition of cash index. The cash index reflects the current market value of an underlying asset providing a benchmark for traders. Comparison with futures prices. Traders use the cash index to compare futures prices, helping to assess market conditions and price movements. Trading opportunities. The cash index can indicate potential trading opportunities based on current market trends and price discrepancies. Foregone interest. Definition of foregone interest. Foregone interest represents potential earnings lost when capital is invested in one asset instead of others. Opportunity cost. Concept emphasizes understanding opportunity costs associated with holding futures positions instead of alternate investments. Investment decisions. Investors should assess foregone interest when making decisions on asset allocation and future investments. Dividend yield. Impact on futures pricing. Dividend yield plays a critical role in determining futures pricing, particularly for stock markets. Dividends influence decisions. When dividends are distributed, they can affect investors' choices between holding futures and the underlying stock. Contracts for difference. Understanding CFDs. Contracts for difference enable speculation on price movements without asset ownership, appealing to many traders. Speculation on price movements. CFDs allow traders to profit from rising or falling asset prices, enhancing trading flexibility. Relationship with futures pricing. Understanding the connection between CFDs and futures pricing is critical for developing informed trading strategies. Net cost of carry. Definition of net cost of carry. The net cost of carry encompasses all expenses related to holding an asset over a period, crucial for investment strategies. Importance in futures pricing. Understanding net cost of carry is essential for accurate pricing of futures contracts and market assessments. Normal situation in equity markets. Futures pricing and cash prices. In a normal equity market, futures prices generally align with expected future cash prices, indicating market stability. Market deviations. When there are deviations from normal market conditions, they can highlight potential trading opportunities or inefficiencies. Yields versus financing costs. Importance of yield comparison. Understanding yield comparison helps investors make informed decisions regarding investment opportunities and risk assessment. Impacts on futures contracts. Favorable yields can significantly influence the attractiveness of holding futures contracts and overall investment strategy. Offsetting financing costs. Investors must consider how favorable yields can offset potential financing costs to maximize returns. Supply problems. Impact of production disruptions. Production disruptions can lead to unexpected shortages, creating volatility in the pricing of futures contracts. Demand surges. Sudden surges in demand can exacerbate supply issues, leading to significant price fluctuations in the market. Traders' awareness. Traders need to stay informed about supply issues to make informed decisions in volatile markets. Market response to supply issues. Impact on futures pricing. Supply issues can lead to increased volatility in futures pricing, influencing trader strategies and market behavior. Understanding market reactions. Analyzing market reactions to supply constraints gives traders insights into potential price movements and market trends. Informed trading decisions. Traders who understand supply issues can make more informed decisions, potentially leading to better trading outcomes. Conclusion: interconnected concepts. Futures pricing relies on various interconnected concepts that traders must understand to make informed decisions in the market. Costs of carry. Costs of carry play a significant role in futures pricing, influencing how traders evaluate the profitability of their positions. Market analysis. Analyzing market conditions, supply issues, and interest rates is essential to navigate the futures market effectively. Thank you.